Welcome to our deep dive on one of the most common money dilemmas. Should you invest extra cash or pay down low-interest debt when you're also saving for a home? In this video, we'll unpack when investing wins, when paying debt wins, how your debt-to-income ratio affects mortgage approvals, and how to craft a balanced plan based on your timeline. Let's get started. Here's the roadmap. First, we'll define the core dilemma. Next, we'll look at scenarios where investing makes more sense than debt payoff. Then, we'll switch to situations where paying debt is smarter, especially if you want a home soon. After that, we'll explain DTI and why lenders care. We'll follow with a step-by-step action plan and a practical case study. Finally, you'll take 2 quick quizzes, and we'll close with the key takeaways. This video is for educational purposes only. It is not financial, tax, or legal advice. Your situation may differ based on your goals, risk tolerance, interest rates, timelines, and local regulations. Consult a qualified professional before making major financial decisions. The central debate is whether to invest excess funds or accelerate repayment of low-interest debt, often under 5%. If you can reasonably expect market returns significantly higher than your interest rate, investing can maximize long-term wealth. However, when buying a home within 1 to 2 years, lenders heavily weigh your debt-to-income ratio. In that case, reducing monthly obligations can improve your mortgage pre-approval and the smoothness of financing. Ultimately, the best use of your money is the one that preserves flexibility, while minimizing obstacles to your near-term and long-term goals. Investing tends to win when the expected return significantly exceeds your loan's interest rate. For example, if you carry debt at 3 to 4%, and can reasonably expect long-term market returns of 7 to 10%, prioritizing investing can grow your wealth faster. This strategy works best when you still contribute to tax-advantaged accounts, maintain a dedicated liquid down payment fund, and have a home buying timeline that is 2 years out or more. It requires emotional discipline to stay invested through volatility. Paying down debt makes more sense when you intend to purchase a home within the next 1 to 2 years. Lenders focus on your monthly obligations because they affect your debt-to-income ratio. Eliminating those payments can dramatically improve how much you qualify for, even if the interest rate is low. Debt payoff also delivers a guaranteed return equal to the loan's rate and simplifies your finances, which can reduce stress during underwriting. This flowchart starts with confirming an adequate emergency fund. Next, it ensures you continue contributing to tax-advantaged retirement accounts, and it evaluates your home purchase timeline. If you plan to buy within 2 years, the recommendation is to direct disposable income toward paying down monthly debt to improve your debt-to-income ratio, while maintaining minimum payments on other obligations. If your timeline is longer than 2 years, the recommendation is to invest excess cash in a diversified, liquid portfolio earmarked for the down payment while keeping up with minimum debt payments. The process includes a feedback loop for quarterly reassessment as your circumstances and the market evolve. Start by funding a 3 to 6 month emergency reserve. Then inventory your debts with balances, interest rates, and minimum payments. Decide on your home buying timeline. Less than 2 years or more than 2 years. Maintain contributions to tax-advantaged retirement accounts if possible. If your timeline is under 2 years, channel disposable income to eliminating monthly debt payments to improve your DTI. If your timeline is longer, prioritize building a diversified, highly liquid down payment portfolio while continuing minimum debt payments. Avoid liquidating existing down payment savings or long-term investments unless absolutely necessary. Track your DTI monthly. Ask a lender to simulate mortgage scenarios and reevaluate quarterly. Debt-to-income ratio compares your total monthly debt payments to your gross monthly income. Lenders consider lower DTI a sign of lower risk. Reducing monthly payments improves your DTI and increases your odds of pre-approval and potentially the loan amount. While exact limits depend on the loan program and your overall profile, many programs have back-end DTI guidelines around the mid-30s to mid-40s%. Removing even modest monthly obligations can meaningfully boost your borrowing capacity. This table shows approximate DTI guidelines. Conventional loans often target around 28% front-end and 36% back-end, though strong profiles can be approved up to the mid to high 40s. FHA commonly targets around 31% front-end and 43% back-end, sometimes higher with compensating factors. VA emphasizes residual income rather than a strict front-end DTI. Back end can often reach the low to mid-40s, sometimes higher. USDA often targets about 29% front end and 41% back end. These are approximations. Lenders vary and your profile matters. On the investing side, you may earn returns higher than your loans rate, preserve down payment liquidity, and maximize tax-advantaged growth, but you must tolerate market volatility. On the debt payoff side, you improve DTI for mortgages, lock in a guaranteed return equal to your interest rate, and reduce complexity. This approach is often best when your home purchase is within 2 years. Consider a borrower with $30,000 in savings and $10,000 in debt at 4% interest with a $250 monthly payment. Gross monthly income is $6,000, and the goal is to purchase a home in about 18 months. Path A focuses on debt. Direct most disposable income to eliminate the $250 payment within 9 to 12 months, improving DTI, and potentially increasing the mortgage pre-approval amount. Path B focuses on investing. Keep the loan and invest $1,000 per month into a liquid, diversified portfolio for the down payment. This accepts market risk, but may increase long-term wealth. If you are close to lending thresholds, the debt-first path is more likely to secure the loan. If you qualify comfortably and prioritize growth, the invest-first path may be superior. Quiz time. If you plan to buy a home in 12 months and carry a 3.5% loan with a $200 monthly payment, what is the smarter focus for most of your disposable income? Option A. Invest in a volatile, illiquid stock portfolio. Option B. Aggressively pay down the $200 monthly debt to improve DTI. Option C. Stop retirement contributions entirely and hold cash only. Option D. Max out a long-term certificate of deposit that locks funds for 3 years. Pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. With a 12-month horizon, improving DTI by removing a monthly payment directly supports mortgage approval. Choosing illiquid or volatile investments, locking funds in a multi-year CD, or halting all retirement contributions can undermine flexibility or long-term advantages. Second quiz. Should you generally keep contributing to tax-advantaged retirement accounts while deciding between investing and paying low-interest debt? Option A. Yes, maintain contributions if feasible, unless you lack an emergency fund or face high-interest debt. Option B. No, stop all contributions until every debt is paid off. Option C. Only contribute if markets are guaranteed to rise. Option D. Contribute only after closing on your home, regardless of timeline. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is A. Maintaining contributions to tax-advantaged accounts is typically beneficial due to compounding and potential tax advantages. Reasonable exceptions include lacking an emergency fund or carrying high-interest debt, which should be prioritized. The key points are: align your approach to the timeline, focusing on DTI if you plan to buy within 2 years, and investing if your horizon is longer. Maintain an emergency fund and continue retirement contributions when possible. Avoid liquidating established down payment savings or strong long-term investments unless there is a strong rationale. Reassess quarterly to maintain flexibility. This Gantt chart maps a full plan over roughly 2 years. It starts with building an emergency fund and auditing debts. Next comes choosing the track and allocating resources. Then you execute either the debt reduction track or the down payment investing track based on your timeline, with quarterly reevaluation milestones. As you approach the 12 to 18-month window, you pursue mortgage pre-approval, followed by closing preparation in the final months. Here is a brief recap using Markdown styling. If your home purchase is within 2 years, prioritize lowering monthly debt to improve DTI. If your home purchase is beyond 2 years, consider investing in a diversified, liquid down payment portfolio. Keep your emergency fund and maintain retirement contributions if you can. Remember, the best plan preserves flexibility and minimizes obstacles to your goals. In summary, base your decision on your timeline, the DTI impact for mortgage readiness, and your risk tolerance. Maintain tax-advantaged contributions and an emergency fund. Follow a disciplined plan and revisit quarterly as circumstances change. Ultimately, select the path that preserves flexibility and aligns with your long-term and near-term goals. Thanks for watching. If this helped, please like, share, and subscribe. Tell us about your timeline, interest rates, and goals in the comments so we can help you think through your plan.